All right, welcome. I'm Kevin Smith, founder and CIO of Crescat Capital. We're a global macro focused investment firm, and we also have a precious metals fund that is something we're really excited about. The topic really is how to attract long-term sticky institutional capital in the mining space, and particularly the junior mining industry. The company's focused on exploration. Can you guys hear me okay? Okay, great. There's 5 key points that I want to drive home here, number one is go after the big prize. And if you think of what's the big prize? So the picture there is Cerro Rico de Potosi. What is that? Well, it's the largest silver discovery in human history, and it's in Bolivia. It was Cortez for the Spaniards was out there looking for gold, but what did he find? He found a mountain of silver, and this thing has been producing for literally 5 centuries, and created the wealth of the Spanish Empire in the 1500s and the Ming Dynasty through the Silk Road trade. So there are still big prizes out there in the metals industry, and the world needs metals today. So when it comes to raising institutional capital from groups like us, from Crescat, and I would think in general, you want to win over the technical experts, and so we'll talk about what that means at Crescat here. You have to do the hard yards. What are the hard yards? Well, there's a lot of things that go into that, but most important, it's drilling. You need to raise capital for drilling, and that is probably the most major thing that you need to do to be a successful mining company in the junior space. And you want to appeal to seasoned investors. This is not this is real stuff. It's not Bitcoin and NFT trading and just going after your gold junkies. This is you want to develop a serious story out there. Now I say avoid broker deals like the plague, but it's okay to raise money from brokers. Just give them a small allocation. Don't rest all your hopes on that the brokerage firms are going to raise capital for you, because you rely too much on that, and a lot of that money is just going to be coming right back in your face and hurting your stock price over time and making it harder for you to raise capital in the next round. So we'll talk more about some of these things. So focusing on the big prize, what does that mean? I think most of us here, know that the big wealth is created on the left-hand side of the Lassonde curve. In the exploration and discovery phase, this is where the billionaires in the industry make their billions, whether it's Tom Kaplan, Robert Friedland, Eric Sprott, Ross Beatty, Pierre Lassonde. This is where the wealth is created in this industry, but it's risky. Institutional investors like Crescat, we want to see the companies take that risk. We want to see them go for the big prize and invest, and we're willing to put together a portfolio of explorers, because most of the exploration companies aren't going to hit. They aren't going to find Cerro Rico de Potosi, but many of them will and can. And so putting together a portfolio in a diversified way of companies that are taking that risk, that are making that investment, we're willing to help give them the money to do the drilling, to make those big discoveries. Maybe 1/3 of the companies will hit and make a discovery. 1/3 of the companies will go on to do to have enough data and gather to go after it for another drill season, and still are going to be around and survive. 1/3 of the companies are probably not going to make it. It's a risky business, and so putting together a portfolio is the way to go for us to realizing that value that's available on the left-hand side of the Lassonde curve. Here's an example of a company that was taken out by Kinross recently for $1.4 billion. And Quentin, our expert at Crescat, says it's not even that great of a deposit. We owned it for a while, and we actually got a 5-bagger out of it. it was a good drill story. Not necessarily the greatest asset out there, but Ken Ross paid $1.4 billion. And it's just one example of a company that, this was a 600 bagger. It went up over 600x from where you could have bought into this stock. It's risky, but there's upside from companies that are successful. So who's our expert at Crescat? It's Quentin Henney. He's got 35 years of experience in the mining industry. He's got a PhD from the Colorado School of Mines. That's when I first met him over about 30 years ago when I moved to Colorado. He's a true expert. He's worked for the majors, for Newmont Mining, for Newcrest, and for his first job was with Homestake, which became Barrick. So his first 15 years was spent working for the majors, doing exploration. He's an exploration geologist. That's his expertise. And the last 15 plus years before joining Crescat full-time 2 years ago was focused mostly on working for junior companies, for exploration-focused companies, making discoveries. He's responsible for many discoveries. He designed the drill program at Fosterville that hit the Swan Zone. 3.6 million ounces of high-grade gold was produced. He advised Eric Sprott and his Newmarket company to buy Newmarket. Eric Sprott was chairman of Kirkland Lake at the time. He advised Eric Sprott to Kirkland Lake to buy Newmarket for this discovery that Quentin knew was there, and Eric, Kirkland Lake did buy them. Kirkland Lake went from a 1 billion market cap company to a 15 billion market cap company, Canadian. Eric Sprott personally pulled out over $1 billion personally when he sold his Kirkland Lake shares. So this is how you can create value and harvest and realize value in the junior mining space. One success story, but Quentin was largely responsible for this. Quentin's advising us. He's a partner at Crescat. If you want to raise money, you need to appeal to guys like this because they know what they're doing. I'll talk more about Quentin if we have time. So the big prize. One of the big prizes, if you're a junior mining company, is perhaps getting taken out by a major. I think most exploration-focused companies, that's their goal. Make a big discovery, get bought out by a major mining company, and so we did a study. We looked at 20 junior companies that were bought out by majors, and there's a variety of them. The majors, believe it or not, aren't necessarily that great at picking which companies to buy out because probably more than half of these didn't turn out to be that great of a purchase. But about 40% of them, 4 or 5 of these really did play out, and for the majors. And but the point here is that on average, when a major mining company buys a junior company, they will pay 22% of the resource value of the metal in the ground around the time of that takeout. Sometimes the companies will have a published resource even before the takeout. Sometimes the resource gets published just after the takeout. And the major producers, they have their own experts and they're making their own estimates based upon the drilling progress of how big they think this resource is. But 20% is the average, 22% is the average. So you think of that Great Bear chart that I showed, and it was up like a 300 bagger from when you start as a microcap company, make a discovery, get taken out. Great Bear was only taken out for something like 16% of the resource value, and it was only an indicated inferred resource, not even the highest quality resource. So anyway, we throw out the outliers for our internal model in here, and we get 20%. That's the average that we use as a target for how what's the intrinsic value of this discovery? How much do we think it can get bought out for? And relative to where the value is today. Here's a look at a macro look at our portfolio. We've invested in. We currently have a portfolio of 83 companies in our activist metals portfolio, and our average ownership across these companies at the median, it's 13.3%, partially diluted, so that includes warrants. Currently in this still distressed marketplace for junior mining, that's about to change very soon, we think. But at this still depressed valuations, that's what's my point here? We own 13% of these companies at the median, including warrants. So they're mostly small and microcap companies. We like to get in when the companies are anywhere between $5 and $20 million market cap Canadian, and that way we can get a big stake. So we go for big targets. Quinton's gross estimates for the targets across all of our companies, 618 million ounces of gold equivalent. That includes gold, silver, copper, nickel, other metals. But in aggregate, each of these companies is going after a big target. So based upon the drilling progress to date, we've been invested for over 3 years now in building this portfolio, and we've had over 100 drills operating around the world across our companies, and combined they have, based upon the drilling progress over the last 3 years, according to Quinton's geologic estimates, they are on target for 290 million gold equivalent ounces of metal discovery. So that's our experts' estimates of the resource that our companies have created. And we've been getting them the money to do the drilling. And so but when you look at that and you compare it to, to put the 290 million target into context, the largest owner of gold on the planet, the U.S. Treasury, has about 260 million ounces of gold. Okay, so this is a lot of metal, and at a time when the world needs metal. And so where, in terms of the valuation opportunity in this segment today, it's so incredible to get. We do the trend mean, so we throw out those outliers, and to get that 20% of the resource value of the metal in the ground, that's 3,800% appreciation potential in our portfolio. I mean, these companies are trading for less than 1% of the resource value of the metal in the ground based on bona fide and incipient discoveries that they hold in hand. And some people in the audience are nodding because they know, they get it. They've been in this industry for a while, and they know how depressed it is and how good the valuations are today. So raising institutional capital is about telling this story to the investors that are out there that are still buying the FANG stocks and the Magnificent Seven, and maybe they've been destroyed in their treasury bond portfolio recently. They're looking for something different. So the junior mining space it's a risky business. Selling the story to big money investors who are looking to add commodities to their portfolio to augment that traditional 60-40 stock and bond portfolio. This is the kind of stuff people are actually looking for, but we got to learn to tell the story in a way that makes it attractive to them. So here's the top 10 companies in our portfolio today. San Cristobal Mining is a private company. It was owned by Sumitomo. Tom Kaplan became a billionaire on this discovery back in the early 2000s. He got out early. The company got in trouble in the global financial crisis, and the minority investor Sumitomo had to come in and basically rescue them and buy them out. And they built a world-class silver, zinc, lead mine in Bolivia, and it is we were able, through Quinton's expertise, to orchestrate a management-led LBO of this company, and at a very attractive price. And the reason that Quentin likes it so much and that we like it so much is they have a new discovery associated with it just 40 kilometers away. That Quentin thinks, could be the biggest thing since Cerro Rico de Potosi. And it's our largest position in the fund today. Snowline Gold, I think they're here at the conference today. Scott Berdal, Quentin knows Scott from early on. We were a pre-IPO investor in this company. It's one of the hottest gold stories in the market today. And I think this company will be taken out by a major. I think every major mining company in the world is looking at Snowline today. El Oro Resources, another major silver, zinc, lead project that we've invested in, also in Bolivia. And the list goes on and on. We have over 80 companies we're invested in. We're willing to invest capital in companies to make discoveries. This is what we do. We put it together in a portfolio that's attractive to big institutional investors and drilling the hard yards. That picture I showed at the beginning, that was Goliath Resources. They're on to a major gold and silver discovery in British Columbia, and we got in early. This one we think is going to be taken out by a major as well. Brixton Metals, BHP has already come into this one and this big copper and gold target in British Columbia. Also, Tectonic, we think this is the next Snowline. Literally, they're in Alaska, but it's still very early stage in that one. I can, if anybody wants to talk to me, after the presentation during the conference, I can talk more about any one of these stories. We only have a couple minutes left, so I'm gonna pause here for questions. This is the performance of our precious metals fund in the 3 years and 2 months that we've been out there and launched it. We've been able to deliver 31% net returns compared to all the benchmarks out there. And how is that possible in this distressed market? I mean, imagine what we can do when we get into a bull market. We did this being long junior mining companies at a time when junior mining companies have been, in general, performing extremely poorly. And even our portfolio is down off its high watermark right now, but the opportunity is incredible today. And so if anyone is interested in learning more about Crescat, wants to set up a meeting, encourage you to reach out to Merrick.